Okay, thanks for joining me. Today I'm doing a quick video on accounting concepts. A very brief video. I'm just going to go through some basic definitions and maybe a few examples of how they work in a context of the financial statements in a sense. So I've highlighted 9 from looking around. I think I had to learn about 7 for my Unit 2 exam, which could have come up, but it's always good to have a good understanding of all of them. So if anything does come up, you can sort of back your own knowledge up with things they don't, in a sense, need you to learn, but it actually shows good knowledge, so it could actually get you more marks. So I think the first one, probably arguably the most important, is prudence. Account should always report a what figure. Well, prudence is sort of being pessimistic, in a sense negative, so they should always report a conservative figure. So a good example of this is simply a provision for bad debts. So we're being prudent, we're thinking that we won't get as much money as we're anticipating getting, so we're sort of decreasing it in a sense. Another good one that is always handy to use is IAS 2, which is the valuation of inventory, which means we should value inventory at the lower of cost or net realizable value. So choosing the lower of them two is being prudent. We're choosing a lower value, so it's going to actually decrease our profit in a sense. So that's basically prudence, just being pessimistic, being slightly negative, being a realist in a sense when it comes to evaluating the value of incomes and expenses. So accruals. Matching something and something to the year they are something something. This results in the correct measurement of profit. So what we match, what do we do with an income statement and a balance sheet? We match incomes and expenses to that financial year, to the year they are. So incomes and expenses, that's earned and incurred. This video is really a test of my handwriting. I hope it doesn't get heckled. This results in the correct measurement of profit. So this is a good example. I sell a good today, but I'll only be paid next year. So say if I sell a car and I give them a year's credit, I say, right, you pay me next year. I'll be putting this in which year of sales. So say I sell cars, it's not a non-current asset, I buy and sell cars, I'm a second-hand car dealership. So I sold it today, but I received the money next year. I'm going to put it in this year's sales. So yeah, basically that's it. It's the year it's the sort of like the transaction occurs. Whether the cash changed hands at that period doesn't matter in a sense. We're trying to match up when that expense or income was incurred, not when we received or gave away the cash in a sense. So I think it's linked to the matching concept, just matching incomes and expenses of the year they are incurred. So realization. Only record a sale once the invoice has changed hands. Sale is recognised irrespective of whether cash has changed hands. So basically that's what I said previously. So it's when the sale actually happens, when the goods change hands and we've given the invoice over, irrespective of whether that cash has changed hands, because we can give them credit terms, can't we? So a good example of this is a sale of goods on sale or return basis. Spell that wrong, haven't I? That's horrendous. So say we give some goods to someone and they're going to return them on they're either going to sell them on, or they're going to return them, or it can happen the opposite way. Someone can give us goods and we're either going to sell them, and if we don't sell them we return them. So technically, say we've received goods on a sale or return basis. Technically we haven't purchased the goods yet, because we're only going to purchase the goods if we've sold them. So we shouldn't include it in our purchases until we've actually sold the goods, because it's on a sort of a conditional basis whether we sell or return them. So if we return them, we technically haven't purchased them in a sense. So yeah, it's quite a simple one. Materiality is quite a nice one. A non-current asset is worth so little it's not classified specifically. So I've put fixtures and fittings there. So say if you have an account, you might have each car in your non-current assets. You might have like a BMW, Mercedes, Ferrari, I don't know. But with fixtures and fittings, you don't see in your non-current assets in your balance sheet table, chair, another table, do you? They just classify it as fixtures and fittings. They group all the assets into one account. So that sort of like makes it simpler. So, and it goes into the balance sheet, or it's not recorded on the balance sheet at all. So a good example of this is if I buy a pack of pens worth £2, I'm not going to put this in my balance sheet because they probably are going to last longer than 12 months a non-current asset would be. And I'm not going to depreciate a pack of pens worth £2 using the 25% reducing balance method, am I? I'm just going to charge it to my expenses and get it out of the way. It's not really going to change profit. It's not that much of an asset. It's just a sundry expense, a general expense. So it's almost common sense materiality. It's not really an asset when it's just a pack of pens. So going concern. So it's the presumption that business will something for the foreseeable future. Well, it's going to be we'll continue trading. So it's basically when we make our financial statements, we assume that the business is going to continue. We're not going to assume that we're just going to stop all transactions, all business next year. We just assume that the business is going to continue going, and that's basically it. It's really simple on that. So it's just the assumption that business continues. So business entity accounts only record the activities of the business. So the business is isolated, it's on its own. We only want the transactions and the activities that business has done. No one else's, that's basically it. Owner's family holiday, this always comes up on a past paper, this owner's family holiday should not be charged to expenses. Well, why? Well, basically, we only want the record of the activities of the business. So why should an owner's family holiday reduce the profit of your business? It seems illogical in a sense. It has nothing to do with the business. The owner has taken he or she's family on holiday, and why should that reduce the profit of the business? It's done nothing to the business in a sense. So that's basically why. I've also put a question mark next to drawings. The owner has every right to could take out a few £100 drawings and take the family on holiday. There's nothing wrong with that. They've put money into the business. They can take drawings out, and once they've drawn that money out, that's it. It's their money. It has nothing to do with the business anymore. It's been drawn out. So basically, yeah, just keeping the accounts of the business on their own from anyone else's, so from the owners or from the employees, etc. It's just the transaction of the business. So consistency, using the same policies and methods each year. So why do we do this? Well, the main reason is greater comparability. So I can compare my accounts from last year with this year because I'm using the same methods to calculate things like my inventory valuation. So a good example is inventory valuation. And there's two that you're made to learn in second year. I think it's two, FIFO and AVCO. But for first years there is another one, which is depreciation. Depreciation, I spelled that wrong as well. That's quite poor. Depreciation calculation. So you could have reducing balance or straight line methods. So you want to sort of stick to one method in a sense. You don't want to change in a sense. But you can do. There are reasons for changing method if there's a very good reason. For example, say if you're in a market and everyone else uses the other method. So say everyone else uses reducing balance method 10%, whereas your business uses 15% straight line. So you could change to their method depreciation because it'll allow you to compare your competitiveness with other businesses in a sense. So that's it basically. It's just it allows greater comparability, consistency. It allows you to draw more reliable conclusions on your statements and your financial data. Okay, objectivity. Accounts should not be what and what by opinion. Well, it's the opposite of objectivity, so they shouldn't be subjective. So they should be based on facts and data. They shouldn't be influenced by opinion. So if an asset is valued by, say, an expert, say if you get one of your buildings valued by an expert in that field, use that value. Don't make up value. So, for example, take a betting company. Say if a football team are 4-1 to win a football match, they'll work that out with a formula. A formula will work out what the odds are. It doesn't matter what the man in the shop thinks the result might be. He might think Arsenal are going to beat Chelsea, whereas the odds don't say that. So in a sense, the odds should not be prone to subjectivity. They should just be objective and use the formula in a sense. So yeah, basically just use facts, don't use opinion, I think is the brief and main conclusion from objectivity. And finally, cost. Assets and liabilities should be valued at historical cost. Well, that's very obvious, of course, because we don't want, once again, you don't want it prone to subjectivity and opinion. And yeah, and that's it. It's only been a quick video, but that's basically what I wanted to do, because I've been getting a lot of emails about accounting concepts. I understand if you're watching this video today, which is the 14th of May, I understand you might have exams tomorrow, so I wish you the best of luck. Any questions, of course, email me. It'll be in the description, and I'll see you in the next video.